And there should always be, if you're stock trading, a stop loss point for you. And that varies from stock to stock. But there is no such thing as, oh, prices have gone down. How about I buy a little bit more? It's another fallacy. It's called dollar cost averaging. And it is recommended by a lot of respectable investment people, and which is a fallacy. If I believe in the stock, that's fine. That's another thing. But just because it has fallen, just to reduce my costs, I buy even more. So I'm basically increasing my exposure to that stock. And you should always, when you see it, get out. I mean, I recently did something like that. Uh, there, there was a stock that I've been holding for a while. I'm managing a little bit of money for my baby niece, and it's called Upstart. They actually do brokerage and debt financing through AI and stuff. They had increased by about 200% over the last year or so. And they started coming down a little bit before their financials for second quarter. I said, it came down 20%. I didn't say, should I buy more? I said, let me close out the position. I closed out around $70. It's 35 now. And I believe in the stock, but that was kind of my stop loss point. Once it hit 75 something, I said, if it reaches, if it goes down 20%, I'm going to close the position. They had a horrible second quarter results, and it's not that easy to do brokerage and loans when the interest rates are this high. Banks have a competitive advantage in this environment because they have low cost financing. Who actually gets an interest from their bank on their checking accounts or savings account? Almost nobody. I mean, I get something whenever I have free cash because Robinhood, if you have a gold account, pays you, I think, 5.15 these days, something like that. It's still below the Fed funds rate, but at least, you're not getting zero. So those guys have built an advantage against a company like Upstart, which has to go to public market to finance themselves, and credit rating becomes an issue. So they end up not doing that well in business. Again, at some point I may buy that stock again. I still believe in the business model, but everything has a price. Maybe if it goes down to $20, I'll buy it again. So Suncoast, not relevant since these are expenses that happen whether or not project is accepted. So next thing we're going to talk about is opportunity costs. Actually, before that, let's talk about so-called side effects. If they're negative, it's called essentially cannibalism. And if they're positive, it's euphemistically called cross-selling opportunities. And these are relevant because we're interested in what changes in the firm as a result of the project. So if Gillette comes up with a 6-blade, I'm definitely going to be foolish enough to buy that, but I'm going to stop buying the 5-blade. That means they're losing sales on that one. I mean, they'll probably reduce the price of that so that they'll get some new customers, who were probably buying the three blade. So it kind of affects it either way. But the sales will never be just the gross sales of the new product. It's the change in net change in the sales of the firm that matters. One thing you should always be careful, whether you're doing this for a new enterprise or you're evaluating a projects within a firm, always be uh, suspicious of claims of cross-selling opportunities, which means as a result of the new product, we can sell more of our existing products. That may or may not be true, but I would, if I'm a CFO, I would never ever accept a new project if acceptance depends upon cross-selling opportunities. I mean, those people who come up with a project do not even have to be crooked or corrupt. They literally believe that there's going to be cross-selling opportunities. But remember, you came up with that project. It's your baby. You kind of have a built-in bias in favor of those things. Yes, optimistic scenario to me in many cases. I mean, if they can justify it based on the research, sure, why not? But a lot of times those numbers are taken out of from the air. You know, oh, we can sell 200 more of our existing products. I know, I've seen how things are done. For new product sales, there's typically some sort of marketing research, but all that other stuff is educated guesswork. And I'm not gonna, let the fate of the company depend upon educated guesswork, even if it is educated. The next one is a little bit uh, opportunity costs. These are again not that important for a new enterprise, but within a firm, they do matter. What do you guys remember from your econ class as definition of opportunity cost? Exactly. It's basically the value of your second best alternative. So if I ask you to lend me $100 and I say, but I'm not going to pay you an interest, you're going to say, but I was going to do something with it and expect to earn something. So I have an opportunity cost and you have to, pay me for that. Same idea here. Sometimes you start a project and, a lot of projects require either plant, property, or equipment. And you need to build a little factory or assembly line over a land, and the company already owns the land, so you don't have to buy it. Naive thinking says, we already own the land. Why would I put the cost of that land into my calculations? But the standalone principle says project stands alone. Okay. Essentially, project buys the land from the firm at the current market value, uses it, and when it's done, it's going to return it back at the market value then. But, since there is time value of money, that's going to create a cost. So they are relevant. Just because if the firm doesn't give you that land, they could actually sell it in the market. By giving it to you, they give up that chance. That means that's a cost to the project. You basically change cash flow of the firm. Even though it's not a real cash flow change, in an economic sense, it is a cost. Assets already owned by the firm and to be used in the project should be considered cost of investment at their current market value. Nothing here. It's not that current.